Good morning. We will pay attention to the reconciliation note. To complete this note, we need information about the profit before tax. If we look at the information in the income statement, the profit before tax is not given, but the income tax is given and the profit after tax. So if we add these two figures together, it will give me the profit before tax. We don't actually want this profit. We want to know what was the inflow of money for income that's more than the outflow of money to pay for expenses. So we have to do the reconciliation note to determine what is the difference between inflow and outflow of money. Although depreciation was in the income statement and reduced the profit, depreciation is not an outflow of money. So the depreciation must be added back to the profit before tax to determine what was the inflow of money. Then interest on loan is shown separately on the cash flow statement. So because it's shown there as an outflow of money, we can't take it as an outflow of money on the income statement as well. Therefore, the interest on loan will be added back. So if I look at the note, I see that I take the profit before tax plus the tax and I add up and I get the profit before tax. Then I will add the depreciation to that amount and I will add the interest to the amount. And those three together will then give me the operating profit before changes in working capital. So this is the actual inflow of money more than outflow of money. If we look at the changes in working capital, we have to look in the balance sheet what is the movement for inventories, debtors and creditors between the previous year and the current year. So first of all, we will look at the inventory figure and we see that inventory decreased in the current year from 453,000 to 394,000. So what happened? If we have less inventory, we sold inventory, therefore there was an inflow of money. If we look at the debtors, we also see that the debtors decreased from 916 to 740,000. That means the debtors owe less money than the previous year, so they had to pay their accounts, so that caused an inflow of money. If we look at SARS, we will not take SARS into account with the debtors because SARS will be taken into account with the outflow of money to pay for income tax. If there's prepaid expenses or accrued income in connection with any other expenses in income except interest on loan, then it will be taken into account with the debtors. Because this prepaid expense is in connection with the interest on loan, it will not be taken into account with debtors because the outflow of money as a result of interest is shown separately on the face of the cash flow statement. So if we look at the effect in the note, we will see that there's a decrease in inventory. Because there's a decrease, we sold inventory, so there's an inflow of money. There's a decrease in debtors, that means the debtors paid their accounts, so there was an inflow of money. If we look at the creditors, we see that there are creditors movement from 930,000 to 1,270. That means that the creditors increased from the previous year to the current year. If there's an increase, the money was not paid to the creditors. The creditors finance the business, that the business owes them more money, so this was an inflow of money. SARS income tax will not be taken into account with creditors because it will be taken into account to show what is the outflow of income tax that was paid during the year. accrued expense for interest on loan will not be taken into account because it's shown separately on the face of the cash flow statement. Shareholders for dividends will not be taken into account because that will be shown as a separate line item, dividends paid. So the only entry that will have an effect with creditors is the accrued expense in connection with the telephone. So if there's accrued expense for any other expenses except interest, you will add it to your creditors figure to see what is the difference between the previous year and the current year. So I will take the 930 plus the 7,900 to see what is the figure for creditors at the end of the previous year, and I will add these two figures in the current year to see what is the effect in the current year. Now, this means that the creditors increased from last year to the current year. Therefore, money came into the business because the creditors financed the business to owe more money. So this will be a positive figure. Then I will add the profit before tax and the depreciation and interest together to give me the operating profit before changes in working capital. And I will take the changes in inventory, debtors and creditors together to give me the total of 575. And then I will add these two together to give me the cash generated from operations. If we look at the calculations and we just follow up on what happened here, then we see that there's a decrease in inventories. That means that we sold inventory, so there was an inflow of money. If there was an increase in inventories, we bought more inventory, then there would be an outflow of money. If we look at the debtors showed a decrease. That means the debtors paid and there was an inflow of money. If the debtors decreased, there's an inflow of money because they paid. If the debtors increase, it means that they owe more money. So the business financed the debtors to owe more money, then it will be an outflow of money. SARS will not be taken into account with the debtors, and prepaid expenses in connection with interest will not be taken into account because it will be shown separately on the face of the cash flow statement. If we look at the result of creditors, we see that there's an increase in creditors. That means that the business did not pay the creditors, and therefore the creditors financed the business and it was an inflow of money. If there was a decrease in creditors, then the creditors were paid so that the business owed them less money, then there would be an outflow of money. If accrued expenses increase, it means that the money was not paid out to pay for the expenses, so it is a positive figure. If accrued expenses decrease, then it means more money was paid, then it will be in brackets. SARS income tax will not be taken into account with the creditors because it's shown separately on the face of the cash flow statement, and accrued expense and income received in advance in connection with any other income and expense will be taken into account with creditors. But if it is an accrued expense in connection with interest, it will not be taken into account with the creditors.